And it is loading. Well, good evening, everyone. Welcome to week number 2 of Busting Money Myths. I am Lauren Williams, a certified financial planner and a 4-time Olympian, and I'm here with my girl, Chloe Moore. Chloe, introduce yourself.
Hi, my name is Chloe Moore, and I'm based out of Atlanta, Georgia, and I'm the founder of Financial Staples, which is a fee-only financial planning firm dedicated to helping tech professionals and employees with their finances.
Awesome. Well, tonight we are busting money myths, and not just one money myth, but multiple money myths. We're going to knock the 5 things out and cover a whole lot more during this process. So for those of you that don't know, the reason Chloe and I decided to start this series is to share our information. A lot of people are trapped indoors during the pandemic. Money is on everybody's mind, whether it's optimizing their finances or financial survival. And we figured, why not share what we know so that people can make better decisions and do things that are going to help them move forward in the future. So without further ado, let's get started with money myth number 1. Chloe, what is it?
Yes, is my credit score is everything.
Yes. Some people believe that their credit score is everything.
Yeah.
And they just swear so much by the idea that if I have good credit, everything else in my financial life will be okay. That is in fact a myth.
Definitely. And I want to clarify credit score versus credit report, because I think people get confused by those. Your credit score is really a numerical number that lenders use to assess your credit worthiness if you're wanting to borrow money. Your credit report is actually a full report and a listing of all of the debts that you have, past and present, and your history of paying those things on time. So it's 2 different things. Your report is the information in your report is used to get your score.
Got it. So what's some of the stuff that's in a report, just to kind of cover that real quick before we get back to our score not being everything?
Yeah, so your credit report, it's going to show all the different types of debt that you have. So then we're going to talk a little bit about that too, just the different types of debt a little bit later. But just, whether it's revolving debt or installment debt, a car loan, auto loan, student loans, things like that. And then it shows for each of those different types of loans, it shows your history. So, if you've made payments on time, if you were late making payments, how much you owe, how much you're paying. So all of those details.
All the things. So the report is like a report card. It says, are you doing good? Are you doing bad? Did you pay late? Did you pay on time? Did you leave something on there for a really long period of time? So we talk collections as well. Those are things that stay on your credit report for 7 years, and you got to wait for them to fall off unless you have some sort of other kind of divine intervention help you figure things out. But we're talking credit score, and we want to tell people why the credit score is not everything. A lot of people think that their credit score is just the end all be all in the world. So when we're thinking about credit score, let's talk about carrying a balance as the first thing on credit cards and how that impacts your credit score.
Yes, I see this all the time. A lot of people think that there's a thing called a utilization score. So it's how much of your credit that you have available that you're actually using. And so a lot of people think that if you're under that 30%, which is kind of what makes your credit score go down, if you're over the 30% and you're utilizing under the 30%, if you carry a balance, then that's a good thing. And that is not true. It's always good if you're going to have credit cards. It's always good to make sure that you can pay those credit cards in full each month. How much of your credit that you have. Okay. But yeah, it's always good to make sure that you can pay your credit cards in full each month and that you're not carrying a balance.
Okay, so don't carry a balance on your credit card, because if you, as an example, have a $10,000 limit and you're using $9,000 of the $10,000, that looks poorly on your credit score. Whereas if you have a $10,000 limit and you use $1,000 of that $10,000, then you're in really good shape.
Correct. And so
that's zero being the best option.
Yes, zero is the best. but yeah, so with the examples that Lauren just used, that's basically if you had it's 90% or a 10%, utilization score. And so generally you want to be at zero if possible, but Of course, under 30 is what helps with your credit score overall.
Got it. Got it. Got it. Okay. So credit score not being everything. It's not the end all be all. So one of the things I always talk to clients about is this idea that while the credit score is important and it is one indicator of financial health, it, like you said, is not the indicator of financial health. So what I've seen quite a bit is people with very good credit scores because they can pay their bills on time every month, but they're kind of drowning in debt. So they have 7 or 8 credit cards in addition to a mortgage and a car and all these different things, and they can pay, but there's not a lot of extra going on. They have no ability to save on a monthly basis. So they've got a great credit score because they're paying on a regular basis, but they're not able to do much else beyond that. So this is why we're saying that my credit score is everything is a myth, is because your credit score being good doesn't mean that you are in great financial health. So I know a lot of times people go out on a date, they're like, I need to know what this guy's or this girl's potential score is. I'm not dating anybody with less than a 700, but your credit score is not everything.
Yeah, you might want to look at how much debt they have in total.
That's a much better litmus test if we're weighing someone's financial health. Another thing people think about is like these rewards. So I can get all these rewards. I can take advantage of all these different things that exist out there when I get a credit card, and I can also be boosting my credit score. So how do you feel about these rewards and in relationship to how it could actually impact your credit score?
Yes, rewards are actually, I mean, they can be really great, especially, if you spend a lot of money on certain categories, you can get, different cashback rewards or, travel rewards or things like that are very beneficial. But the problem is people, sometimes want to take advantage of the rewards, but they're not responsible with their credit card. So if you're carrying a balance, that means you're paying interest on that amount that you're carrying, and that's going to far exceed the rewards that you receive.
Definitely. So to be mindful of the idea of being able to pay your credit card bill in full every month. One, because keeping the utilization low is going to help that credit score for real. But two, because you buy things trying to get the rewards and then you realize you don't have enough money to pay for things. You don't have a proper budget in place. Now you find yourself in the credit card debt. And the other thing too, when you're thinking about credit card debt, is that it's kind of on a rolling basis. So your bill closes, let's say on the 28th of the month. Then you get the bill in the mail on the 11th of the next month, and it's not due to maybe the 28th of the following month. So you're paying for things way back in the day, and you feel like, well, I didn't spend that much money this month, but what you got to get is the bill from last month where you might have spent a lot of money, and things get kind of thrown off because it's not equal to like what you're doing today versus what you've done in the past.
Correct. Yeah.
All right. So the other thing is this idea that investing will get me rich quick. So we're switching over to money myth number 2. Investing will help me get rich quick. I hear it all the time. Chloe, do you hear it frequently in your
yes. Yeah.
Why do people think that investing is going to help them get rich quick?
Yeah, I don't know. It's just I feel like a lot of people come to me and they just they want to make their money work for them, or they want to flip their money. And that's really not the best way to think about long-term investing. And there's a big difference between investing and gambling.
Yeah, I would say there's definitely a very big difference between investing and gambling. They are not the same thing at all, actually. Gambling is taking your money to Vegas and hoping to turn it into more money, which generally leads to you losing all your money. And investing is something that you should be doing for the long term. So the idea is that 20 or 30 years from now, that money that you put in now has grown gargantuanly in proportion to the amount that you put in, because you were able to take advantage of what we call compounding interest over the time. So one thing with this idea of getting rich quick is a lot of people don't realize that saving is the most important aspect of investing. And people don't tend to think of those as one and the same, but I do think of them as one and the same, because you have to first put money away in order for your money to be able to grow. You can't put $1 in and expect that $1 turn into $1 million. That's where gambling comes in or something.
Yeah, I want to talk a little bit about saving versus investing too, because generally with savings, I think of savings as more of a short-term thing. and investing as a longer term thing. So with saving, you want to make sure that you're putting your money in a safe place, and you don't want to take a lot of risk because you want to be able to access it quickly in case you need it. So think about like emergency funds, any short-term savings goals if you want to buy a house in the next few years, if you're saving up to buy a car, things like that, that you'll need the money in a relatively short period of time, and you want to be able to access it quickly. It needs to be safe. With investing, it's definitely more of a long-term perspective. So it's money that you hopefully won't touch for the next 10, 20, 30, 40 years. And so you can take a little bit more risk with that money because it's longer term.
Definitely. So you're able, because it takes a longer period of time, to say like, okay, it's okay if this money goes down a little bit because the market can also go back up. So as an example, COVID hit, and a lot of people went crazy because they're like, the market's crashing. What do we do? What do we do? For our clients that are generally in their 20s and 30s, it's like, we do nothing. There's no reason to panic when something big, even a big dip like this comes along. You continue on with your plan as planned, instead of freaking out because you got a 20 or 30-year time horizon.
Yeah, and we also have money set aside, for savings and for short-term needs.
Mm-hmm. Oh, maybe that's a good thing we could talk about, is the kind of order of operations as it pertains to before you're ready to invest, what should you be doing? And if you can do some baseline investing, what does that look like? Where can you put money kind of easily to get started with investing?
Yeah, so the biggest priority is making sure that you have some emergency savings. Generally the rule of thumb is 6 to 12 months of your living expenses, but I know that's kind of daunting for some people. But if you just have some small amount that you can set aside and then continue to build on that from there. But just starting out with some kind of emergency money, so you're not having to go to credit cards or other other means to get access to money that you need quickly. That'd be the first piece. The easiest way to dip your toe into investing is through your retirement plan at work. So a lot of companies, you might hear about companies that do like a match on your 401k. That's free money. So you should always want to take advantage of that. If they're going to give you a 6% match, you want to contribute 6% so you can get that free money. So that's a good way to just start with investing, but still focus on building your emergency savings first.
All right, so before I invest my money, I should have an emergency fund of some sort, form, or fashion, ideally with 3 to 6 months of income set aside. But if it's not realistic, at least get something set aside for a rainy day. Beyond that, if I work at a traditional employer, they generally have a 401k or a 403b, and I can put money into that. What is the maximum amount that I can put away on an annual basis with my employer?
Yeah, so that's another thing I think people get confused about, because they say, they'll come to me and they'll say, I'm maxing out my 401k, and they're putting away up to the company match, but that's not the maximum that you can put in. So for 2020, it changes every year, but for 2020, the maximum that you can put in is $19,500.
Yeah, so that is a really important thing. Max, M-A-X, is not the same thing as match, M-A-T-C-H. Yeah. A match is you taking advantage of free money, and that's usually a single digit percentage of what you're saving for retirement, and your employer is also matching that amount, so you're saving double. That generally is not going to get you to retirement. So if you're looking for kind of benchmark numbers, we say generally that you should be saving around 20% of your income if you want to be on track for retirement. So saving 3 or 6% is not going to be enough. The max, however, is $19,500, which is a really cool thing to be able to do. So a lot of people are worried, like, I don't know what account to invest in or how to do investing. I need to take a class. It's so overwhelming. You can take advantage of something that's right in front of you in the form of your employer retirement plan. And until you get to that $19,500, you don't need to worry about opening a Roth IRA or a brokerage account or a Robinhood account or all these other different kinds of apps that exist. Just use the one that you can easily swipe right out of your paycheck. They have an online portal for the most part. They ask you how much you want to put, and it's just that simple. So don't be afraid to keep it simple and just get started by saving. And by saving, we're saying putting that money into your retirement account.
And I'll add something else too. On the flip side, if you have higher income and you are able to easily max out, you have your emergency fund, all of those things are in place. Some people stop there and they think, oh, I'm maxing out my 401k. I don't need to save anything else. And so that's also a misunderstanding. I think, just like you said, Lauren, people need to save a minimum of 20% of their income if possible. And really ideally more than that. And the longer you wait to save, the higher that percentage can be.
Yeah, that's another thing we bump into quite a bit is, someone coming to you in their 50s and they've got very little saved. And to get on track for the way that they've been spending and the lifestyle that they've created, they're going to have to cut their expenses way back right now in order to have a life anywhere near similar to that in retirement. So it behooves you to start now, right now, even with a little bit in your 20s, so that you can get to your 30s and bump that up a little bit, get to your 40s, bump that up a little bit, and be in really good shape in your 50s, as opposed to, oh my God, like retirement's around the corner. I hate my job. I don't want to work there anymore. What do I do? Also, I wanted to say that if you guys have questions, go ahead and drop them down in the comments. We're happy to answer them as we go. So this is a live for a reason. Engage with us. We're happy to talk to you.
Yeah. So we can move on to the next topic, which is debt. I think that's a big one.
Yeah. So we talked a little bit about the credit score and the credit score being kind of related to debt. Because that's another good point, is that your credit score is a means to take on debt. So you have a really great credit score, which means you've got a really good ability to take on debt. Ultimately, we do not want to take on debt. Sometimes it's going to be necessary, but in general, we want to avoid taking on debt so that we're not owing somebody something all the time. So the first thing I wanted to talk about was like this idea of like installment debt versus like revolving debt. Can you talk a little bit about the differences between the two?
Yeah, so for installment debt, you're basically paying on a fixed schedule. So think about like a mortgage or a car note or something where you have a fixed schedule and you're paying the same amount each month to pay the debt down. And you're also not adding to the debt. So every payment that you make helps to reduce that debt until it goes away. With revolving debt, which is credit cards is most common, but there's also, home equity lines of credit or just personal lines of credit. With those, you can continue to add to the debt. So that's a big difference there.
Yeah, and I think it's important that you understand the difference between the two. So one thing is with the installment debt, one type of installment debt that I deal quite a bit with is student loan debt. Mm-hmm. So a lot of people come to me and they're wondering, am I going to be able to purchase a home in light of this big 6-figure student loan debt that I have? The answer is yes, but you also still need to be very mindful of taking on additional debt if you have a large student loan debt, and making sure that, like you said, all your finances are organized before you go into the home purchase. If you didn't watch last week's, we talked extensively about purchasing a home and all about home buying and the myths related to that. So check that episode out. But installment debt is saying, okay, I have this amount of debt. And when it comes to home buying with student loans, if you're mixing student loans, so taking on additional debt when you have this debt, what they actually look at, if you're on an income-driven repayment plan, which a lot of people are, so that means you have federal loans, and every year you report your income to the federal government or to your loan servicer, and they calculate your payment. They're going to calculate your ability to take on more debt based on that monthly payment, not on your total student loan debt. So that's actually a really good thing that works in your favor if you want to purchase a home. So I'm saying all that to say that having student loan debt does not prohibit you from purchasing a home, but you definitely want to have an organized plan before you add additional debt to your life without a clear plan in place.
Yeah, definitely. And another thing I think it's important to talk about is the idea of good debt versus bad debt. And so I think good debt, when I think of something that's considered like a good debt, I think of something that you're taking on debt for something that's going to appreciate in value or something, or you're making an investment in something. So, student loans can be a good debt. You can also get a little out of control with them, but overall they can be good debt. If you're investing in your future and if you're increasing your ability to earn more income, then that's a good investment. If you have a house, if you're buying a house, that's something that, should over time, over the long term, appreciate. And so that could be considered a good debt. When I think of bad debts, I think of credit cards and, personal lines of credit and personal loans, things like that. They have a higher interest rate, and it's mostly for, just frivolous spending a lot of times when you get into that kind of debt.
Yeah, I think another way to think of the good debt versus the bad debt is like, I'm investing in myself in some way that is going to pay me returns in the future. So, we just talked about investing and uh, the idea of it overall, but that's it. There is no get rich quick scheme. In the same way, sometimes you need to take on debt and you need to pay that back over time to see the return on the investment. So, student loans is one way. Generally, you take on student loans so that you have more ability a better ability to be able to be hired and more earning potential. So you're hoping that that investment is going to take off and you're going to get the return on the investment. I will say that what I've seen quite a bit now is, the cost of education going up so much that it's not actually matching up all the time. So you take on $300,000 or $400,000 of student loan debt, but your income goes up, maybe $10,000 or $15,000 in the grand scheme of things, and it doesn't actually help you earn more income. One good example of this is veterinarians. So generally, veterinarians have around $400,000 of student loan debt, and on average, they make around 80K of income. I've dealt with them extensively in my work at Student Loan Planner, and it's really tough to see someone take on that amount of debt knowing that they're not going to have enough income to be able to pay it off, or they're not going to take in a really luxurious job. And I think there's a lot of perception around the prestige of a job. So physicians are another ones that people think make lots of income. You're like, well, you're a doctor, like you got it. You make six figures, you should be fine. And we make a lot of assumptions about what other people are earning without knowing, the full story behind their picture. And it's none of our business anyway, like, unless we're trying to pay their debt off for them. But really understanding what kind of debt you have and the way it can become good debt, and planning ahead before you take on that debt so that it is actually good debt. So that's doing research if you're going to buy a home, which we're calling good debt, prior to doing it. It's doing research with student loans as well before you say, I'm gonna just take on all the debt because I want to go to this school, I don't want to work while I'm in school. What can I do to reduce this debt so that it's manageable, so that I can pay it off? What jobs can I get with the major that I'm choosing? The more that you know on the front end, the better a decision you can make so that you can get that return on investment.
Yeah, that's so true. And I'll give you a special shout out. Lauren is the student loan guru. She knows everything about student loans. Whenever I need help with student loans, I call Lauren. So she can definitely drop in the bottom, in the chat, just her information at the end. But she does student loan consultations as well. So
student loans are my jam, so I could talk about that all day and all night. I think the other thing, actually, one more thing on student loans is like this idea of like consolidating your loans. So being aware of whether consolidation versus refinancing is appropriate for you, and understanding what the difference between the two are. So consolidation is taking federal loans and squishing them down, consolidating them. So you may have like 8 or 9 loans when you look at your bill on a monthly basis, or if you look at your FSAID, there's a whole bunch of different things listed for the various years and the various terms that you took out debt. Consolidating them would squish them down, but they would still be federal loans. However, refinancing the loans, sometimes people refer to that as consolidating because it does become just one loan. So technically it's been consolidated. But what happens, the big difference is that happens in a private system. So SoFi, Common Bond, Earnest, if you have student loans, you're probably getting junk mail from all of them. Those are the companies that are doing private loan refinancing. They're giving you a lower interest rate, which is great, but you lose all the options as it pertains to what your loans are at that point. So right now during COVID, anybody who has federal loans, it has 0% interest and has $0 payments. You're not obligated to make any student loan payments right now. If you got private loans, you still need to make those payments on a regular basis. Your interest is still kicking in, and you need to take care of that. So before you jump into the refinancing boat, make sure that you're in a financial position to pay your loans down, because that is truly your only option at that point. And also make sure that's appropriate for you to be making a strategy to pay the loans down. So I know this might sound a little bit weird to people, but there are strategies that are related to forgiveness. So there's public service loan forgiveness, and then there's also taxable forgiveness. With either one of those plans, your goal is not to pay your loans off. It's to pay as little as humanly possible toward your loan, and use the rest of the discretionary income that you have to build yourself a solid financial future. So not everybody's in the boat of paying your loans off. You don't want to get in the pay slow boat and it costs you a bunch more money if that's not the appropriate boat for you. Only way to tell is to set up a student loan plan for yourself. And if you don't know how to do that, then call your girl because I can help you out.
But yeah, I mean, once again, just to reiterate, don't make a quick decision as far as refinancing. Like, make sure you really understand what you're doing, because you could make a big mistake.
Exactly. All right. And so then last but not least, as we talk about debt, prioritizing. So if you've got a lot of debt right now, Chloe, how should people think about like what is, I should tackle this first versus that first? There's just so many different things out there that I've got going on. Which of these debts do I tackle?
Yeah, so I would say the first thing that I always say to tackle is credit card debt. If you have any type of credit card debt, anything with a high interest rate, 15, 20% plus, that should be tackled first. And then next you can look at things like maybe like a car loan, or just other things like that. But the quote unquote, like we said, good debts, those are things that you should look at last, and really think about like a good plan for paying those off, and how that fits into your overall situation.
Yeah, you wouldn't believe the number of times that I've had clients reach out, or people who have shared their debt pay down strategy with me, and they're tackling their mortgage, paying double payments or $500 extra every month, but they have credit card debt.
Yeah.
And the mortgage, though it's much bigger, has a single digit interest rate, 2 or 3% or 3 or 4%, whereas their credit cards are, accruing interest at 25 or 29% every month. And also not helping their credit score, because like you said, once again, it's that revolving debt. So you definitely want to prioritize, and it's about optimizing your finances. So it's not as cost effective to be paying extra towards your mortgage when you have credit card debt or some other high interest rate debt. So
and just to tie back to the investing piece, that's another thing. We talked about just having priorities as far as saving versus investing. A lot of people want to invest, and they set up brokerage accounts or go to Robinhood or all these different investing apps, and there's credit card debt. So if you're paying 20% interest rate, you're losing 20% a year. So think about that before you start investing.
Yeah, that's a really, really good point. All right, so let's move on to our fourth financial myth. This is a myth that always like kind of raises hair on the back of people's neck. This is like a touchy subject. I have been cussed out by folks who have been sold some really bad insurance by their insurance salesman for telling them that, this is not a good plan for you. So let's start by talking kind of property and casualty insurance, renter's insurance. I know you got a pretty cool story that you want to share with us, right?
Yeah, and so the first thing I'll say is insurance is typically sold; it's not bought. So that's something to think about. People who sell insurance, they make a commission off of the products that they sell to you. So their incentive is to sell you insurance. All roads are going to lead to some kind of insurance. So that's the first thing to think about. Just always consider how someone is being compensated when you're speaking with them, and how that aligns with the advice that they're giving you. So
pitch, the sales pitch, and sometimes not advice, it's a pitch, right?
Yeah, definitely. And so the first thing is just with property and casualty insurance, what that means is that category kind of covers like your homeowner's insurance, your renter's insurance, your automobile insurance. If you have like a motorcycle or things like that. And also you might have heard of like umbrella liability. So all of those things kind of go under the category of property and casualty insurance. And so one of the things that we see a lot too is when people are renting, whether it's an apartment or if they're renting from a private person who owns a house, a lot of people forget or they neglect to buy renter's insurance. So that's something you should always buy renter's insurance. It's usually only $100 or $200 a year. It's super expensive, or super inexpensive.
Right. Like $12 a month. Like it's very, very affordable.
Yeah, it's very affordable, and so that's something that's super important. So what happens is, let's just say your apartment burns down or something stolen from your partner. So if anything bad happens, you need to have insurance to be able to cover that loss. So that's what renter's insurance would cover. So just, I saw a story on the news recently, and there was a woman who was renting a house, and her house burned down. We had some thunderstorms a couple of weeks ago. Lightning struck her house and burned it down. and she didn't have renter's insurance.
Yeah.
So she's having to go to GoFundMe, and neighbors are donating clothes and just everything else that she needs because she lost everything.
Yeah, I think you bring up a really good point too about, us having to depend heavily on others and their finances when we have a financial catastrophe, because we don't plan ahead for it. We like to take the risk, but then once, we kind of get bit in the butt and, lose the gamble, if you will, because that's what we're doing. It's like, I don't want to spend the $12 on this. I'd rather spend my $12 on something else. But then you have a catastrophic loss and it costs you a lot more than what that $12 a month would have been. Um, and now you're kind of having to pull on a tug on the heartstrings of others to help you cover this, and it puts financial stress on them as well. So when we think about insurance, that we threw a little shade to the insurance agents on the front end, but the whole myth is that you don't need insurance. Yes, you do. You very much so need insurance, and insurance is a way to cover the people that you care about should something bad happen, and to cover yourself should something bad happen. So just to be considerate of that. Like you said, like it's not a GoFundMe. So when I think about life insurance, it's the same thing. Someone passes away, and frequently in the African American community, we set up a GoFundMe page really quick because a funeral is not cheap. It's roughly, I've seen like $6,000 as an average, and I've seen a lot more than that. I'd say the average is probably higher than that nowadays.
Yeah, at least 10.
Yeah, like
Yeah.
funerals are not cheap. So if you don't have $100 in the bank right now, and somebody and your friend doesn't have $100 in the bank, and then they pass away, and you can't just leave them in the morgue, now we're having to figure out where to come up with this $10,000. This is where life insurance can come into play. Just even some basic life insurance to cover the cost, so you're not creating a burden for someone else. I know we just went through this with my grandma. They moved her to hospice, and I was like, we need to start having the conversation around like what we're going to do as it pertains to funeral arrangements. And in the state that she's in, it's extra expensive because you can't put people underground. You got like all these different rules about additional vault and casket, and so she's in Florida, and it's very expensive. And she's not in a financial situation to be able to pay for funerals. There's nothing left behind, nothing that she's passing on to us. So the family members that have been around are going to have to come up with that money, and we're going to have to divide those expenses, and everybody is in a different financial situation. So some people can only put in a couple hundred bucks, but why is it the person who makes a little bit more, I got to put in a couple $1,000? Like, hey, wait, hold on one second. And so you just wish you would have, I would have gladly paid $50 a month for the last couple of years if I could have, in order to have this covered, as opposed to having to come up with a larger sum now. And like I said, argue back and forth with family members about who's going to put in what, and it affecting their finances. So
Yeah, and so let's talk a little bit more about life insurance. The first thing is, if you have anyone who's dependent on your income, or just dependent on you in general, then you need life insurance. So that's the first piece. And then the second piece is just, a lot of people underestimate how much life insurance they need. So think about how much, if people are dependent on your income, how much of that income needs to be replaced for them to just cover basic living expenses. How much income is needed, or how much money is needed to bury and cover those final expenses. If you have debt, do you want to pay off the mortgage, so your spouse won't have to worry about it if you pass away. So just thinking about all those things, those numbers can add up quickly. And so you might have a $250,000 life insurance policy or $100,000 life insurance policy, and that's not going to cover it.
Yeah, I always like to put, like you said, real life scenarios with this. So let's say you are a gentleman with 2 children, and your wife stays at home and looks after those children. Well, you might say, well, I'm the breadwinner, so only I need life insurance. But what happens if your wife passes away? You now need childcare because your wife has been covering childcare up to that point. And you're going to still need to be the breadwinner for those 2 children. So they're going to need aftercare as well as, all day long if they're toddlers, et cetera. So you want to make sure you can cover the cost of having the appropriate people come in and look after your children should something catastrophic happen. On the flip side of that, as whomever in the household is the breadwinner, if you pass away, the income goes away and you leave all these people alive that have been dependent on your income without any income. So what does it look like for people to not have that to cover the mortgage, to get their groceries, and not just for 1 year, you're dead forever. Like you don't get to come back. Um, and so you really got to think about, how long would I like to cover these people? If you know you have a 5-year-old child and you want to cover them until they're 18, they get to college, or cover them until 21 through they get to through college. Think about how much it would cost for them to have a roof over their head and be fed, and their college education to be paid for. These are the things we're thinking about. It's not just making somebody rich because you bought life insurance. It's a worthwhile investment to make sure that they're covered over the long term.
Yeah, and in your case with the breadwinner, if the breadwinner passes away, let's say the surviving spouse, if they're not in a position where they're able to work, maybe they have been out of the workforce for a long time and just can't earn a lot of income. That's going to affect retirement too. So you need to have money. That needs to be factored in. How much money does that survivor need to cover retirement expenses and really carry them through the rest of their life?
Yeah, it is no small feat to think about those things, and it's better to think about them when you're perfectly healthy than to be, like you said, in catastrophe mode and trying to figure them out. We have a comment here from Antonio, and he says our community has people that believe if I'm not here, it doesn't matter. And I would say that definitely has been the sentiment that I've heard from people is, once I'm gone, I'm gone. So but I think that looking down on it later, they would say like, gosh, I wish I would have, done this to do that to make sure that everybody was good. So
yeah. So, and the other piece of insurance that I want to talk to you guys about is disability.
Mm-hmm.
So that's another one that a lot of people just don't think about, or they neglect to get that coverage. So disability basically covers you if you become injured or sick. And it replaces your income basically due to an accident or illness. So think about, if you got into a car accident and you were out of work, like if you broke some bones or something bad, it was a bad accident and you couldn't work for 3 months, then if people are dependent on your income, or if you have to care for yourself and pay your bills and continue to live, then, that's a problem. So you need to make sure that you have some kind of insurance there to cover your expenses. And as a young person, you're more likely to become disabled than you are to die. So.
That is very, very true. We are far more likely to have some sort of accident that leaves us alive and unable to work than we are to actually kick the bucket. And another thing to bring up too is, as an entrepreneur, you don't have like maybe the employer disability insurance that's a couple more bucks to throw onto your paycheck, but it's something else to need to be thinking about. And this is what I always kind of just warn people when they're thinking about, like, I hate my job, I don't want to be, I want to be my own boss. With being your own boss comes a lot of responsibility. You eat only when you make money, but in addition to that, you lose all those cushy employer benefits. So there is no 401k. You got to set that up yourself.
Health insurance.
Right, employer match. You are doing the match. So all the money that you put in, there's no free money anymore. Health insurance is the one that like knocks people's socks off. You go from paying like $7 or $80 a month in your out of your paycheck to $800 or $900 a month to be covered properly with good health care. So to be thinking about all the things that you give up as an entrepreneur, and disability is one of those things, because like I said, it's a huge deal when you can't work because there's no support system around you via the employer should something happen.
Yeah, and even if you have it at work, I mean, I've seen where people didn't quite understand what it is and maybe they opt out of it. But if you have that as an option at work, if that's a benefit that's provided to you, make sure that you sign up for it.
Yeah, it is an important one. All right, so then we didn't do auto insurance. So that is one thing that is left. So kind of falls in the P&C category, property and casualty. But one thing I always like to encourage people to do is have more than the state minimum of car insurance. So Some people get the car insurance just to check the box. Like they told me I only need 25, 10, 25. That's all I'm getting is $12 a month. You don't want $12 a month car insurance. Because what happens if you end up in a car accident and you are found liable? They're going to be coming after you, your personal finances, and you want to make sure that you're covered.
Yeah, and so to give an example, a lot of times you hear like 25, 50, 10, or just all these different numbers. So the first two numbers cover like bodily injury. So if someone gets hurt physically and they have medical expenses, things like that, That's what those first two numbers cover, and it's in the thousands. And then the last number covers property damage. So if your state minimum is $10,000 for property damage, if you go out and hit a $50,000 car, then they're going to come after you personally for the rest of that money. So that's just something to think about. If
very, very true.
Yeah.
Which brings us to actually one more type of insurance that we didn't cover a whole lot, but it's umbrella. And so umbrella insurance is like an umbrella. It covers you for a rainy day. So the purpose of umbrella insurance is if you were to max out all of your auto insurance and also, maybe all of your homeowner's insurance, depending on what the kind of event that happened, someone comes after you and they still want more, the umbrella policy would cover you above and beyond what those insurances covered. So you're gonna need to be insured more than the minimum in those regards for the umbrella to even be a possibility. And it's really great for those that are high earners or celebrities, people who are likely, like some people try to rear in physicians on purpose because they know that they have, income to support or income to come after. So you want to be mindful of that if you're in a vulnerable situation.
Yeah, and the higher your net worth, the more you have, the more important umbrella liability becomes. It can really help in situations if you have a house and you have a pool, you're having pool parties, inviting people over, slip and fall, accident, those types of things are where liability coverage comes in place.
For sure. All right, so then last but not least, in our 5 money myths that we are busting up today, making more money means I have to pay more taxes. Now, this is a myth if I ever heard one. Chloe, tell us how you feel about the fact that making more money means you got to pay more taxes. So do you want to make less money now so you don't have to pay no taxes?
Yeah, that's always interesting. People sometimes complain about the fact, I had to pay all this money in taxes, but I mean, it's really a frame of mind. There are things that you can do to reduce your taxes, but generally speaking, if you're paying a lot of taxes, that means you're making a lot of money. So that's not a bad thing.
Yes, I think you brought up a really good point too. It's mindset. So there is a narrative in America that paying taxes is bad. We don't want to give Uncle Sam any of our dollars. We should cheat as much as possible because we don't get to choose what to do with those dollars. And I kind of think of it as like tithing. It's another thing that's kind of controversial for people. A lot of people are believers in, whatever their religion is, but they don't want to give additional dollars to the church because they don't get to decide what to do with those dollars. With Uncle Sam, you can go and you can actually look up what our tax dollars are being spent on and whether you agree with it or not. Now, that's a completely different thing, but there are actual allocations to what your tax dollars are being spent on. And one thing I always like to bring up to people is the government programming. So Social Security, welfare, disability income for those that it's applicable to. And I think we probably all know somebody that has benefited from those sorts of things that exist. So your tax dollars are going toward taking care of one of those people. And imagine if, nobody pays any taxes anymore. How do you cover, grandma's, like my grandma's in a nursing home. Well, now she's in hospice, but how do we take care of those kind of expenses if the government doesn't step in and close the gap for her via Medicare, Medicaid, and, government assistance, Social Security, et cetera?
Yeah, definitely. And another thing is just the difference between a tax preparer and a tax planner, because I think there's, people hear the word CPA or they hear EA or enrolled agent, and some people just go down the street to the the tax place on the corner, and or they go to a friend's house. So there's a lot of different places that you can go.
Pay taxes. Right?
Yeah. So there's a lot of places you can go, but generally speaking, you want to go to someone who's qualified and has some kind of certification. So CPA and EA, those are two things to look for if you're looking for a tax preparer.
Yeah, and I think one really big red flag that we see frequently are people who do your return for you and then have you sign the return as if you did it. That is a no. If they are not willing to say that they did your taxes and they want you to sign and say you did your taxes, even though they just helped you fill all this stuff out, they probably did something they weren't supposed to do on your taxes. And cheating on your taxes can land you in jail. The other big risk that you run with cheating on your taxes, though it is an honor system, and a lot of people try to kind of buck the system by taking full advantage of, things that are not necessarily true, is that you can be audited. And if Uncle Sam comes back around to audit you and wants you to prove all the things that you put on your tax return, you can end up in big trouble and end up having to pay a lot of money. So,
And that's typical with a lot of people who are self-employed. If you have a business, like there's a lot of things that people try to write off that may or may not be legit. So.
Right. Athletes all the time, they want to write off everything they eat. And I cannot say the number of athletes that have come and have been literally writing off every bit of food, all their groceries for the last however many years, and are super grumpy when I tell them, food is something that everybody needs to eat to live. So that is not tax deduction for you. But I have to shop at Whole Foods. I have to have a higher quality of food so that I can perform. That's not a tax deduction. We all have to eat, and we all get to choose what we eat. And so just to be mindful, they said just because the IRS didn't come and tell you, no, you can't do that, doesn't mean that it wasn't wrong, and doesn't mean that you should rectify it as soon as possible when you find out that you are doing something that doesn't really line up with the IRS code. And the other thing I'll say too, you mentioned like a CPA versus an enrolled agent versus, a tax preparer of some sort, or somebody who just like does taxes. You get what you pay for. So yes, there is an investment of money when you hire a certified public accountant or an enrolled agent, and it's probably a little bit more than it is with a tax preparer or the free TurboTax online. But who is going to really look into your situation? Who's going to ask you the right questions to make sure that you are maximizing your tax strategy? So what if paying that CPA $300 ends up getting you that refund of $3,000 versus you doing it on your own and you only got $1,500? You don't know what you're missing out on by not having a professional help you get through the process.
Yeah, and the best people are ones that are proactive, and so they're not they're not just looking at what happened last year. They're helping you to think ahead for what's going to happen this year, and how can you make little changes to help reduce the amount of taxes that you're going to owe in the year ahead.
Yeah, that's a really good point. There's a difference between tax planning and tax preparation. You can take your tax documents that you get in the mail January, February of every year, turn them into someone, they crunch some numbers or put it in some software, and they prepared a tax return for you, versus someone who is gifted in the area of tax planning, who's going to say, okay, what are we up against? How many stock options do you have? When is the baby due? Should married filing separately help you if you were, because you have student loans? They're thinking about all the different strategies that exist because they have expertise, and you share your personal situation with them, and they can help you kind of guide you guide you toward the things that would be most cost effective for you. So tax planning versus tax prep, and a certified or enrolled agent, a certified public accountant or enrolled agent versus a tax preparer.
Yeah. Yes. So just to summarize here, there's a big difference between tax strategy and just flat out cheating. so you want to make sure that, obviously, we want to pay the least amount that we can legally. But that requires some strategy and working with someone who's qualified.
Yeah, and just to drive the point home, this idea about mindset, trying to cheat the man and buck the system and, kind of gamble or, steal, if you will, is the wrong mindset. If you operate from a position of abundance and I have more than enough and I'm organized, so because I have organized finances, I realize I have the ability to pay these taxes and I still have enough to save and invest and do all the other things. When you start operating from a position of abundance, more money will come your way. And you'll be figuring out how, okay, I got to pay more taxes, but guess what? My paycheck is a lot fatter too, which is going to allow me to do all the things that I want. So not to be thinking from a place of scarcity, but better thinking of from a place of abundance.
Yeah, definitely.
Oh, one more thing about taxes, because we talked about entrepreneurs. So PPP is something that was a really big deal over the last couple of months. And it was for small business owners to be able to get some relief as it pertains to COVID. We talked about self-employed people writing off everything, trying to write off every single thing and have no expenses. The result for a lot of self-employed people was they were not eligible for PPP because of that. So you make a really good living every year, but you somehow make everything that you come in also an expense. And so it looks like on paper you don't make a lot of money. Well, it was time for PPP and you weren't eligible for your 2.5 times, the monthly income, because what they did is if you're not like a S corp or a company of some sort, you use line 31 on your Schedule C, and line 31 on Schedule C is what shows your profits. So you had no profits because you had so many expenses and you missed out on PPP. And it happened a lot, like you said, once again, in the communities of color, because we're cheating the system, or we're trying to finagle the system, and now something came around, and a lot of people that didn't look like us were able to take advantage of that because they were doing their finances differently. So
yeah, and I think too, another thing to think about is, if you want to get in a position where you can qualify for a loan, whether you want to buy a house, buy a car, get a business loan, any of that kind of stuff, just being able to show some kind of income is beneficial. So if you're writing off everything, if you're showing a loss every year or barely showing any income, that's going to hurt you when you need to have income to be able to borrow money.
that is a very, very good point. All right, I feel like we busted these money myths. We killed the game today. Let's see if we have any more comments. I don't see any more, so we're good to go there. All right, so to wrap it up, I think we should just, Chloe, if you tell people where we can find you, if they're looking for help from you, what they can get, and yeah, shout yourself out a little bit.
But yeah, so my website is financialstaples.com. You can follow me. I'm on Facebook and Twitter at Ben Staples, and Instagram at Financial Staples. So yeah, those are the places you can find me.
And I'll drop those in the comments as well. But I have to say, Chloe just got an Instagram page, and I'm so proud of her for doing so.
I know.
She has joined the world, guys. So make sure you head on over there and encourage her to start posting on Financial Staples.
Yeah, it took a while, but I finally went over to the dark side.
Yes, and I am Lauren Williams. My company is called Worth Winning. I help young professionals in their 20s and 30s better organize their finances. So whether that is needing help with their student loans, needing help creating a budget, starting to invest, understanding your 401k, we're getting married, we don't know how to manage our finances together, how do we, kind of merge things, you name it, all things money related that young professionals are dealing with. I like helping people organize themselves and optimize their finances in that way.
And where can we find you?
Worth-winning.com.
Okay.
I'll put that in the chat as well.
All
right. Well, you guys have a wonderful evening. And without further ado, we will see you next Tuesday for, what's our topic next Tuesday?
Financial advisors.
Financial professionals, hiring a financial professional. So this is not for us to pump ourselves up. This is to really educate you all on what a financial professional is, what kind of financial professional may be appropriate for you, and to give you good access to the resources that are relevant, so that you can make a good decision and not be taken advantage of. Because that's a lot of people out there that are not interested in getting help because they feel like it's all like kind of a scandal and a scam and they're going to be taken advantage of, and they don't really understand what a financial professional does. So we're going to break those down for you, and then you can choose the one that's right for you.
Yeah, definitely.
All right, we'll see you guys next Tuesday.
Bye.